Hi, everyone. So my name is Jeremy Clark. I'm a professor at Concordia University in Montreal in information systems engineering. I also hold industry research chair in blockchain technology sponsored by NSERC, Raymond Chabot, Grant Thornton, and Catalexy. All right, so what I want to talk to you today is something called DeFi. So let's assume that you have a great idea for some new financial service. One option that you have is you could write it up as code and you could push it to a blockchain. So Ethereum's a public blockchain. It's one of the most popular ones. And what the blockchain technology will give you is it will give you a certain security guarantee, which is that your code is going to run exactly as you coded it. Okay, it's not going to save you if you make a software mistake or something like that, but it will guarantee that it will execute exactly correct. And so a lot of people have started to look at this technology and they've started to come up with their ideas for decentralized finance services, and they've deployed them. And they've been live on Ethereum, particularly in 2020, this really picked up. And now there's about $10 billion worth of tokens and other Ethereum assets that are locked up in these decentralized financial services. So what I want to do is I want to give you a whirlwind tour. I apologize, it will be a little fast, but I want to give you a tour of some of the different things that are involved. And in order to sort of situate the tour, what I'm going to do is I'm going to talk about a particular incident that happened. It happened in February of this year. And I woke up, I checked Twitter, and everyone on Twitter was talking about this incident that happened. And so you can see some pictures of it. And obviously you can't go through all of the details now. Don't worry about that. I'll go through the details myself. But basically what happened is somebody went around to 4 or 5 of these different DeFi services. They did it in a single transaction. So it happened in a blink of an eye. And somehow they made $300,000 doing this. So I looked at these pictures and, I had a bunch of questions. So the most obvious question is, well, who are all of these services? What exactly is it that they do? I also wondered, people were talking about it as if it was an attack. And so I thought, well, is it actually an attack or is it just maybe arbitrage where, different assets have different prices and somehow you're able to buy low and sell high? Or was there an actual exploit that was involved? The person who instigated it, they made $300,000, as I mentioned, but that means somebody lost $300,000. So who was it? Was it the users? Was it one of these services? Was it shared across the services? Where's the money coming from? And then as an academic, you want to look at an attack like this and think about what are the foundations or the principles of this attack? Are there other variants that are possible? Now, I'll note that $300,000 isn't, it's not a huge amount. It's not going to make the headlines of the New York Times. But what we have seen is we've seen copycats of this attack. So just a few days later, someone basically victimized the same service and they were able to get twice as much money, $600,000. And just last month, the exact same service was hit again, and this time they lost $8.1 million. So the trend is clear. It's an upward trend of losses in this space. All right, so let's start our tour. So we're going to start with something called stablecoins, and we'll just talk in general about the currency that's available to you if you're on a blockchain. So one of the advantages of doing finance on blockchains is you have currency at your fingertips. Ethereum comes with its base currency, Ether. There's a competing blockchain system called Bitcoin, which you've no doubt heard about. You can actually have Bitcoin on Ethereum. The details are kind of complicated, but they'll be relevant for this particular incident. The one thing that you didn't have for a long time is you couldn't have Canadian dollars or US dollars on the blockchain. But now people have stepped up and they've had proposals, they're called stable coins, for assets that are pegged to a traditional government currency. And so I'm not going to go through all the details of how these work, but we did write an article recently that has a very good overview of it that's in the communications of the ACM. So I'll refer you to that for more details. All right, so next on our stop is lending. So lending is very central to a lot of DeFi services. So there's different ways of doing lending. The most basic kind is, Bob shows up and says, I want to borrow 80 ETH in this case. And you give it to him because he has a good reputation and you think he's going to repay you. This basically doesn't exist on Ethereum. Okay, the reason it doesn't exist on Ethereum is because, first off, everyone's anonymous, or at least pseudonymous. So you don't know who people are. You don't know what their credit ratings are. This is just too risky. Now, there are people that are looking to bring identities and credit ratings and those kinds of things onto Ethereum, but this is probably a couple years away before we see this type of loan. Now, there is a second kind of loan that's a lot more narrow in how useful it is, but it is something that you can do on Ethereum today. So the idea here is, let's say you have some extra ETH and you want to earn interest on it. So you can deposit in a kind of like bank kind of structure, and somebody can borrow your ETH, okay? But because we don't trust them and we don't know who they are, what we're going to say is, if you want to borrow the ETH, let's say you want to borrow $30,000 worth of ETH, then you have to post collateral in a different token. Okay, so maybe you have Bitcoin. So you could say, well, you can borrow $30,000 of ETH, but you're going to have to post $40,000 worth of Bitcoin as collateral. And then if anything happens, like exchange rates change or you fail to make repayments or whatever, we're going to liquidize your collateral and we'll repay the loan. The thing I really want to emphasize here is the bank is autonomous. It's just code. Think of it like a vending machine. You just walk in, up, you put your collateral in, you get your loan out. Okay, there's no humans that are reviewing it. Everything happens automatically and instantly. All right, the third kind of loan is the coolest kind of loan. The reason it's so cool is because you can actually do this in the real world. So it's called a flash loan. And before we talk about how it works, I want to talk a little bit about how Ethereum processes what are called transactions. So the word transaction, you might think that sounds like a single thing that you might want to do. But what you can do is, if you have 4 transactions that you want to make, you can bundle them together in a single transaction. So one transaction can do multiple things. There is some upper limit that doesn't really matter for the purpose of this talk. Now, where this gets interesting is, let's say you try and do 4 things and the third thing you try and do fails. What should happen to that transaction? And so Ethereum is flexible enough that they let you choose what you want to happen. So common options would be you could just skip over it. So you could do 1, 2, and 4. You could stop once you hit 3. So you do 1 and 2, 3 fails, and so you don't try and do 4 or anything that happens after. Or you can do what's called a revert. Now, revert looks really nice on this slide. It looks pretty, and it's hard to grasp how significant a reversion is and what it actually means. But let's think about what that means. What that means is you do 1, you do 2, 3 fails. So you actually go kind of like back in time. You rewind the state of the world so that function 2 never happened. And then you rewind the state of the world so function 1 didn't happen, and you cancel the entire transaction. Now, this is possible on Ethereum because only one transaction executes at a time. So let's say you pay someone and then something happens and you want to undo that payment in the same transaction. You can do that because there's no possibility that they spent the money in the meantime, because in order for them to have spent it, they would have had to send a transaction, and that transaction would have had to interrupt your transaction before your transaction was finished. So that's not the way Ethereum works. Ethereum, when it's your turn to do your transaction, you get to do that transaction. It runs to the end, or it reverts and it goes back to the start, and then it's someone else's turn. So everyone takes turns in terms of transactions. So what you can do is you can actually turn this into a crazy kind of loan, where what I say is, you can borrow any ETH that you want. You can do whatever you want with the ETH. You pay it back, and I'm going to check whether you paid it back at the end of your transaction. If you didn't pay it back, then I'm going to revert your entire transaction, including the fact that I even loaned you the money in the first place. So in other words, you get a loan only in the case that you actually end up repaying the loan. And if you don't end up repaying the loan, it's like you never got the loan in the first place. Okay, so there's some like time bending logic here. And that's what makes it like so different from things that you would normally see in finance. Because of this, it's basically a risk-free loan. And so anyone can get it. They can get it in enormous amounts. They can get it almost for free, and you can be completely anonymous. All right, it's also kind of a loan, but it's slightly different. It's called margin lending. So the idea here is, let's say you want to invest in Apple. So you could go buy a share of Apple for $120. Maybe it goes up to $200, and so you make the difference. You make $80. Instead, if you want to kind of accelerate your earnings, what you could do is you could take your $120 and post it as collateral for a loan, and somebody, the broker dealer, will lend you, say, 10 times that amount of money, so $1,200 to go out and buy Apple shares. Now what happens is if Apple goes up a bit, what you do is you make money at 10 times the rate than you were making before. Okay, so that sounds too good to be true. And the flip side of it is that if you lose money, if Apple starts going down, the big problem is you start losing money at 10 times the rate than you did before. And so you don't have to lose a lot of money. If Apple, for example, goes down to $108 a share, then you're completely broke. You blew through your $120 collateral. And if Apple goes down any further than that, then the exchange is actually on the hook because they lent you the money and it eats into their loan. So this is possible to implement on Ethereum, and people have done it, but you really have to watch the prices carefully, and you have to make sure that you can liquidate things fast enough if the prices start to move. Okay, final stop on our whirlwind tour are exchanges. So exchanges is basically the idea of you have Bitcoin and you want Ether, and so you're going to swap some Bitcoin for some amount of Ether. Normally you go to a website or something that's not on-chain in order to do this. But there is one way of doing it that's on-chain that's instant. So if you're in the middle of a transaction, you want to instantly turn one kind of token into another, you can use what's called an automated market maker. Now, this is very rudimentary, but it works and it's popular because it's instant. So the basic idea of an AMM is as follows. Think of a vending machine again. So you have a vending machine, it has a big pile of pink coins and it has a big pile of blue coins. And if you want pink coins, you can do that. You can ask for a pink coin and it will say, okay, you have to put some blue coins in order to get a pink coin out. Now the trick that I won't go into the math of is the more pink coins that you pull out, the more blue coins it costs you to put it in. So if the pink pile starts to get pretty sparse, then you're going to have to come with an enormous amount of blue coins. And to pull like the last pink coin out, you would have to have an infinite number of blue coins. And so basically it will never run out of one of the two kinds of coins. Now this has some properties. So basically if you aren't buying a lot of tokens, you're just buying a few, then it's pretty good. You don't get a lot of price difference. But as soon as you start buying a lot of them, then you get a really bad price. This is called price slippage. Now, the other thing is, let's say you go through with it anyways. You say, I don't care, I'm going to get a bad price. Give me a whole bunch of pink coins, even though I'm going to way overpay for them in terms of blue coins. Then the next person that comes along, the vending machine is full of blue coins, and they're now really cheap relative to pink coins. So someone can come in and put some pink coins in, and they can get the blue coins for way less than they should. Okay, so this is a property that will be kind of instrumental in the attack that we'll talk about now. So let's go back to February 2020, and let's try and understand what happens. So before we break it down, let me just give you the high-level principle. So the high-level principle is actually pretty simple. Mallory, the malicious actor, she tricks Alice into overpaying something using Alice's own money. So by itself, this already is an attack. There's no reason for Mallory to do it other than pure malice, right? Because it hurts Alice, but it doesn't benefit her. But if Mallory could be the person that sells these overpriced assets to Alice, then she could actually turn it into something that would be profitable for herself. So she's actually taking money from Alice and putting it in her own pocket. So Alice in this story is a DeFi service called BZX. And BZX implements that margin trading utility that we talked about. So Mallory shows up to BZX with a big pile of Ethereum, a relatively large pile, so $350,000 worth of Ether. And she says, okay, I want to post this as collateral. I want a loan for like 5 times this amount of money, and let's buy some Bitcoin with it. So BZX says, fine, here's $1.5 million, and let's go convert it into Bitcoin. Now, this is a lot of Ether to go out and try and buy Bitcoin with, especially if you're going to do it instantly on chain. And so the only thing that would offer that amount of liquidity would be one of these automated market makers. In this case, it's called Uniswap. Okay, and the amount of ether that they're putting in is like triple the amount that it has currently. So this, I just want to emphasize that this is an enormous trade that you're asking Uniswap to do. And as a result, remember, if you buy a lot of tokens, then the price goes, you get a really bad price. Okay, and so it turns out that they only get like 50 Bitcoins out. So what happens on this trade is they lose about $1 million. Now, who's they in this scenario? Who exactly is it that's losing? And so the answer is that, well, Mallory's losing some of the money. She's losing her initial collateral of $300,000. Okay, but BZX is losing the rest. Okay, so already this is a kind of attack where you could spend some of your own money in order to make someone else lose even more money, but it's not really a good attack. You would like to make the money yourself. The other thing I'd like to say is that BZX in this case should not allow this trade to happen. They should have looked at it, they should have staged the trade, understood that they're going to lose money on the trade. The amount of money they're going to lose is greater than the collateral that they were given, and they should have reverted the whole thing. It turns out that they had the logic for this in their software, but for whatever reason, it wasn't reached. And so Mallory was able to exploit the fact that this logic wasn't kicking in the contract. So this is, for this reason, I would actually call it an attack. It's not just a simple arbitrage opportunity. All right, so now as a result of this trade, we have a whole bunch of blue coins relative to pink coins. And so what does that mean? That means that blue coins are super cheap. So if we can kind of do the opposite after, if we can come up with a bunch of Bitcoin, then we can get Ether for cheap. And so that's exactly what Mallory does. So she comes with about $1 million worth of Bitcoin, and she's able to get $1.8 million worth of ETH. And the difference between these two numbers is bigger than the amount of money she lost in her collateral asking BZX to do this trade in the first place. So basically, this is great. Now, the problem with this attack, well, it's not a problem, but there is one other issue with this attack, which is this is a great attack if you have millions of dollars sitting around. What if you don't have millions of dollars sitting around? Well, what she was able to do is she was actually able to get a flash loan for that amount of money. So it wasn't her money, she just got the loan. She got about $2.6 million worth of ETH. So she went through the top half of the attack. And then for the bottom half, she needed Bitcoin. So what she did is she took the ETH, she deposited it in a service called Compound, which gives you this kind of bank loan. And so she used $1.5 million worth of ETH as collateral to get the $1.1 million worth of Bitcoin in order to do the bottom amount of the attack. So anyways, if you stare at this long enough, you'll realize that the math works out. She has enough money to repay the flash loan, and she's even able to pocket just a tiny bit of money, $26,000, okay? But there's still money to be made here. Because of this bank loan, what happens is the bank loan is over collateralized, meaning the ETH, if she can repay the Bitcoin that she borrowed, she gets the ETH that she posted as collateral, and the ETH is worth more than the Bitcoin because that's what the bank wanted in order for it to be a safe loan. So what she does is she does the reverse transaction where she repays $1.1 million worth of Bitcoin, and she gets her ETH back, which is $1.45 million. And so she makes $300,000 on that on top of the $26,000 that she made when she completed the first part of this transaction. Okay, so maybe you didn't follow all the details of it, but anyways, this is a pretty cool attack. And another thing you might ask is, well, how much does it cost to conduct? So Alice, it's not free for Alice. So Alice has to pay some service fees and she has to pay Ethereum to run the computation. But the amount that adds up to is very small. It's $135. So basically with $100 in her pocket, she was able to move, $2-3 million through this whole financial service system. And she was able to net hundreds of thousands of dollars. Okay. So that's pretty remarkable. And there's a lot of components here that we don't normally see in financial crimes that are novel. So I thought really hard about what the takeaways would be for you for listening to this talk. And I don't have a lot, to be honest, because I think it's still too new. It's an emerging area. We know that there's novel techniques being used. We know the size of the losses are already pretty big, and we know that they're getting bigger over time. And so all I can tell you is that we're really interested in this space. So about half of my students are working on stuff in this space, and we're sitting down. We have a grant now from the regulator in Quebec for the financial markets, AMF, to study these exact issues. So if we cross paths later, hopefully I'll be able to tell you some new results on providing consumer protection in a DeFi world. So thank you. I'll take your questions in the question and answers, or if you are watching a recording of this after the conference, then you can reach out to me on Twitter and ask me anything you want. Thank you.